Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
This week on Wall Street Wrap-Up, inflation numbers are released by the government for December. We'll tell you what they reported. A third set of classified top-secret documents have been found belonging to then Vice President Joe Biden, stored in his garage, and Attorney General Merrick Garland appoints a special counsel to look into the matter. And stocks end the day with all the indexes ending higher. Are you sure we're headed for a recession? I'm Andre Laborde. We've got these stories and more. It's Friday. That means it's time for Wall Street Wrap-Up. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up on this Friday the 13th. Well, coming up tonight, we're going to be talking with CNBC's senior markets correspondent, Bob Pisani. Bob covers the markets from the floor of the New York Stock Exchange for CNBC. He's just written a great book called Shut Up and Keep Talking, of the history, traditions, and investing he's learned from both reporting and being on the floor of the NYSE. Bob Pisani is going to be joining us in just a moment. But first, the Bureau of Labor Statistics released December's jobs numbers, and the economy is growing, but at a slower pace. Now, before we get to that, the Dow Jones ended and the S&P 500 ended a 4-day win streak, while the NASDAQ had a 6th day of gains. The NASDAQ had its longest winning streak since November of 2020. This week, the Dow Jones ended the week at 34,302, which is up 2% for the week. The S&P 500, they ended at just almost 4,000, which was up 2.6% for the week. And the NASDAQ, they ended today at 11,079, which was up just over 4% for the week. The Consumer Price Index for December was released by the Bureau of Labor Statistics. The CPI inflation numbers released this week show a drop of 0.1% for December. It was the biggest drop since August of 2020. Now, for the year, inflation was still up at 6.5%, which is down from November's numbers. Well, December's core CPI, which is without food and energy, was actually up for the month at 0.3%, and for the year, it was up just over 5.5%. Core CPI is usually used because of those sectors, because the high volatility of food and energy is taken out for a better inflation picture. Well, for December, while inflation has gone down 0.1%, inflation at the grocery store, well, that's up almost 10.5% from 1 year ago. So, with the new CPI numbers coming in and inflation coming down, what will the Federal Reserve do? Will they raise rates another 50 basis points or 0.5%, or will they only raise it 25 basis points? We'll know in just a few weeks. The next meeting will be on January 31st. Let's get to our guest tonight. Bob Pisani has written a great book, Shut Up and Keep Talking, on the traditions, the history, the investing he's learned reporting from the floor of the New York Stock Exchange for CNBC. Hi, Bob. Welcome back to Wall Street Wrap-Up.
Andre, great to be with you.
When you first got to the floor of the New York Stock Exchange, you had about 4,000 people on the floor. The New York Stock Exchange covered about 80% of the business. What is it like today?
It's different today. The NYSE, what happened on the floor, is a very good example of technological disruption. As you said, when I got here in 1997 in the summer, there were 4,000 people on the floor, and they did 80% of the volume, the trading in all New York Stock Exchange listed stocks. Today, there's maybe 200 and 250 people, and they do 15 to 20% of the volume. That's a very noticeable difference. And what really changed was several things, but basically the growth of electronic trading. In early 2003 or so, the New York Stock Exchange bought Archipelago, which was an electronic exchange. The Arca exchange is one of the exchanges here at the New York Stock Exchange. And the NYSE trading still, the floor trading still, of course, exists. But a lot of the volume now goes through that Arca exchange.
Is John Thain looked upon as more of the savior, the hero, or with disgust because of the fact, I mean, he was the one that kind of moved it towards more of electronic trading?
Yeah, John Thane came in and did what he had to do. He was not a popular figure on the floor because he came in very immediately after Dick Grasso left in 2003 and bought Archipelago, an electronic exchange. Well, the floor guys weren't particularly enamored with electronic trading because it hurt their business. So understandably, they weren't enamored with, but I think Thane did what he had to do. There was moving in that direction anyhow. NASDAQ was already, it had been largely electronic already. And the combination of technology, of the software, combined with the hardware, enabled sub-second trading. And that's what the public wanted. It was faster. To a lot of extent, it was more efficient. So that combined with the different pricing that how it, I mentioned had changed, really created a necessity to come in and make some very difficult decisions. And I think Thane did what he had to do, though he wasn't popular for it.
Do you still see New York and New York City as still the hub of the financial markets?
Well, yes, a lot of people move to Florida, but don't kid yourself. New York is still the financial capital. And when things head south, you'll still see reporters lined up out front of the New York Stock Exchange. You know, Wall Street is still is largely a state of mind these days. When I got here in '97, the big houses, the Goldman Sachs and Morgan Stanley, were all right in this neighborhood immediately. Many of them, like Morgan Stanley's in Midtown now. So things have changed. The world is a little less centralized, and probably that's a good thing. But yes, don't kid yourself. A lot of the intellectual capital around the world of finance, and certainly in the United States, is still in the New York region.
The New York Stock Exchange now not being privately owned by owning a seat there, but now being publicly traded. Are a lot of the traditions of the NYSE going away?
Well, no, yes and no. So, for example, one of the big traditions is around Christmas time. The retired traders come down here again and sing "Wait Till the Sun Shines" Nelly with the existing people on the floor. We're actually going to do that again this year, January 30th at 1:30. Art Cashin, who's the sort of doyen of floor traders, is going to come back and is going to lead a group singing there on the floor. We still have the annual Christmas party. So, yes, there's fewer people around to do that, but some of the traditions definitely are still here.
The traders on the floor. When I remember when you first started, when they just had a fixed camera, and at one time your colleague Maria Bartiromo was there. It didn't seem to be really happy with the breaking of tradition of having actual reporters on the floor. I mean, I remember very well, and this might have happened to you too, while Maria was doing her stand-up, traders would be walking, and they would just by sheer hitting, brushing her while she was live on camera. Did you find it was hard to break into the club?
It was like a fraternity, a very exclusive fraternity, a club, private. It was literally a private club. It was a mutual association. It was owned by the members. You had a seat. There was a luncheon club upstairs that had a huge business every day, and so it was a very elite organization. And to get into that organization, they had to trust you. They didn't particularly trust reporters. They didn't know many of them. So it was difficult. And a few people, including Art Cashin, kind of stepped up and really helped me out, which I'm eternally grateful for, and said, hey, you can talk to Bob. He's all right. They just wanted to make sure that they could say things to you that wouldn't necessarily get them into any kind of trouble at all. So I had to figure out a way to report the news. In theory, there was a whole piles of potential information that was on the floor because there was a lot of trading being done. But if nobody's going to talk to you about it, it's kind of hard to get through to that.
You wrote the book, Shut Up and Keep Talking. And I would think that when it comes to being on the New York Stock Exchange for so long, you've got friends, you got family, you go to parties, Christmas parties, whatever. And sooner or later, they come up to you and look at you and go, Bob, can you give me some stock tips? Can you give me some stock advice? What do you invest in?
Well, it's always disappointing when I tell them I don't give stock advice, but I can tell you what I do. I'm a Jack Bogle disciple. Bogle was the founder of Vanguard. Meeting him, and I talk about this in the book, was the most important thing that happened to me in my life. I met him in 1997, and it changed the way I look at a lot of things. There were other people that influenced me. If you want to know what kind of books that mattered to me, Jack Bogle's book, Common Sense on Mutual Funds, came out in '99. Jeremy Jeremy Siegel's book, Stocks for the Long Run, is out in a new edition. That had a big influence on me. The bottom line to me is I don't trade at all. First off, we're restricted. I can't own individual stocks except the company that owns us, which is Comcast and was General Electric before, or individual bonds. I can own mutual funds and ETFs. And by and large, that is what I own, largely ETFs. But I describe what I own in the book. I consider this to be the single most important thing I did. Lots of reporters write books about their experiences, including financial reporters, but almost nobody says what they own. I'm amazed at this. Nobody ever asks me this question. People will ask me what the market is doing and what I think the market is doing. And I've come to understand they're talking about what's happening 3 to 6 months. Some people ask me about the mechanics of television, like what's so-and-so really like, or what do they say when they talk in your ear? By the way, that's how you got the name Shut Up and Keep Talking, because most of the time the producers either say rap, which means shut up, or stretch, which means keep talking. That's what you typically hear. Shut up and keep talking. That's how the book title came about.
I've got my IFB in my ear right now, Bob.
But the important thing is I describe my whole investing journey, including what I started buying in the early 1990s. We could talk about my investing mistakes, but right now, I don't think it should be a surprise to anyone that my biggest holding is the S&P 500. That's a core holding for anybody. I own a small cap value fund. I own a mid cap value fund. I own an international fund. And basically, when I show this to people, you can put it on the back of an index card. People are disappointed. They're like, you're the senior markets correspondent for CNBC, and this is what you own? They're like waiting for me to tell them. I call them the Illuminati secrets. I own double inverse Malaysian bonds that you never heard of. You don't know about that?
Uh-huh.
No, because that doesn't work long term. You think that you could find some corner of the market and do market timing. If there's anything I learned from Bogle, I still believe market timing does not really work. You have to be right on an investment going in, and then you have to be right going out, and you make all sorts of mistakes. And generally the market tends towards long-term, towards moving back towards an equilibrium. And it's very, very hard to say. So for example, this year I'm going to buy thematic tech stocks. I'm going to buy cybersecurity stocks. There's an ETF for that. There's a cybersecurity ETF. And it turns out, if you watch this, cybersecurity stocks outperform for a very, very short period, outperform the market. And if you bought on that low going in and sold at the perfect top, you made money. Everywhere else you didn't doing that. Well, nobody knows that. Nobody knows when those perfect entry points are. People exhaust themselves trying to do that. People convince themselves that they can outperform. Generally, they don't. And the academic literature on this is overwhelming that most people, including professionals, can't do it.
In the last 50 years, let's say, and we're talking about active trading as compared to passive trading, such as putting it with an S&P mutual fund. If you put $1,000 in the S&P for the last 50 years, but you missed one day, the one day of the best day, you were down like $20,000. And if you missed the best 5 days, you were down much more. If you missed the best month, when people will tell you or say, I'm going to take it out right now, but I'm going to put it back when the market starts to pick back up again, what would you tell them?
Terrible idea. That's market timing. First of all, I can tell you what I do, which is nothing. Jack Bogle used to say, don't just do something, stand there. Resist the urge. What you really need is a plan. And this plan is going to depend on your risk tolerance, the costs that you're doing it, how much you can afford to put away, and what your expected returns are. The stock market is the best long-term investment out there. It beats real estate, it beats bonds long-term, not every single year. So the stock market has gone up, and this is all in the book. On average, the S&P is up year over year, 75% of the time. 3 out of 4 years, the S&P since 1926 has been up. Now, that's not every year. There are years when it's down. There's a few years where it's down a couple years in a row, but that doesn't happen very often. The market tends to go up, and it goes up more on the upside than on the downside. So 56% of the time since 1926, the S&P 500 has been up 10% or more, 56% of the time. It's only been down 10% or more year over year, 12%. Now, why does this happen? This is the critical point about this. Why does the stock market tend to go up over the long term? The reason it tends to go up is because of the nature of capitalism and the particular kind of capitalism that's practiced in the United States, which is, I guess you would call it, corporate capitalism. In the United States, the means of production is still primarily controlled by individuals and corporations. These individuals and corporations tend to be ruthlessly efficient when it comes to allocating capital. Just look at FedEx today. They're not doing well. They're doing cost cutting, ruthlessly efficient allocators of capital. There's capitalism elsewhere in the world. In Europe, for example, France. France has more state-oriented capitalism where the government owns larger parts of the means of production. That's still capitalism, but that kind of capitalism tends to be a less efficient allocator of capital. This is why the United States tends to usually, not always, but usually do better than the rest of the world. So again, why does this happen? Because of the form of capitalism that we practice. You can say, I don't like this form of capitalism. It's ruthless and nasty. That's a different argument. I'm simply addressing why does our market and why does the stock market tend to go up? And that's the answer.
Sure. Bob, when it comes to going public, the way it normally has, a company wants to go public, they've got a certain amount of years as being private, they go on a tour and talk about their stock, they get investment companies like Goldman Sachs or others like that to be designated market makers and guarantee. But today you've got abilities such as, let's say, a SPAC, special purpose acquisition company, or I think there's been tried this year, maybe last couple of years, of letting the market decide where the price will flow. Do you still see the old way as the best way, the way it's been going?
Well, when you say the old way, are you talking about IPOs?
Correct.
I'm not a fan of SPACs.
Yes, IPOs.
SPACs has been a problem
IPOs.
because people mistakenly thought somehow SPACs was some shortcut to go public without having to reveal a lot of information. We see how that has ended. So the initial public offering route is still the best way. The problem is a lot of companies, because interest rates were low, stayed private for a long, long time, way too long. So now the public doesn't have the benefit of a young company. Some of these companies going public, now they've been around for more than 10 years. You want a company that's young for the IPO, and so the public can participate in the growth of the company. I want easier ways to go public without hurting the investor protections that we have. It's a very, very fine a line. But IPOs are my favorite thing down here. There's a whole chapter in the book about watching Alibaba go public, the biggest IPO of all time, $25 billion. And spending some time with Jack Ma down here was just a wonderful thing. But in general, you get to watch people get rich. Mm-hmm. Think about this. For most people, it's the biggest day of their life. They bring their family down. Suddenly, they're on the floor. They ring the opening bell, and then they go over and wait for the stock to open. And they're staring at the screen, looking at the indications. It's priced at $20. The indications are it's going to open at 23. You know what they're doing? They're trying to figure out their net worth. They're looking at the saying, okay, let's see. I got 1 million shares here. I'm at 22, and now I'm worth.
And Jack Ma was probably one of the biggest. Jack Ma was. Sorry? I mean, when Alibaba went public,
he was the biggest. 25 billion. Yeah, his net worth was close to. I did it in the book. I think it was 18 billion, something 19 billion. He sold at the open, and then so it was enormous. He made a lot of money.
Now we're in 2023. Do you think Chinese stocks, at one time, David Faber was even mentioning how there were so many Chinese stocks that were going IPO. Do you think that, and I'm thinking because of the political climate, because of TikTok, because of Alibaba with Jack Ma, do you think that there will be as many Chinese companies going public in 23? As they were?
To the extent that it's easier to go public in the United States than it is, for example, in Hong Kong, yes. I don't give investment advice. I don't say buy Chinese stocks. I don't do any of that. I will say this, that there is a very interesting debate that has emerged in the last couple of years that did not exist about whether or not, what political risk is involved here. We do know this. It's much higher than we thought. So 5, 6, 7, 8 years ago, we were all saying, well, if China is 15% of the world's market capitalization, for example, then you should own a global fund that has 15% China stocks in it. That was pretty much gospel. And what's happened is the ideological differences, particularly since the rise of Xi Jinping, are so great that there are people who are saying, we should not necessarily just invest because of market capitalization. China is a fundamentally different ideology. It's largely state-owned capitalism. Is that what we want here? Should there be a different way of looking at China, not just from political risk, but even from the desirability of wanting to invest in that kind of ideology at all? And I think that is a legitimate question. I think there are legitimate questions. There are people out there who don't care. I know people who will invest just because of market cap. I know people who are value investors who say, well, if Chinese stocks traded below 14 times forward multiples, I'll be a buyer. And they're not ideological. They don't care about this. But for the rest of us, I think that's a legitimate question. I'm not coming down on either side of that. All I can tell you is I have had people on who've expressed that opinion, that we ought to consider China as a bit of a special example. And those people are, I think, are raising some legitimate intellectual questions.
Explosion of NFTs, of other things other than stocks as an investment, to be becoming bigger in the year ahead or the years coming up?
No. So there's a very simple way to ask about this, not NFTs, about crypto as an asset class. That's what you're asking. Mm-hmm. Is crypto an asset class? So here's what I would say. Asset classes are stocks, bonds, real estate, commodities, arguably, those four. Crypto as an asset class. The thing I would ask is very simple. What does it do for your asset class? So the two things that I would say you need to do is it has to offer some kind of diversification, and it has to offer some kind of price improvement or stability in some way. Is there diversification? Well, yeah. Is there any kind of price stability? Does it lower your volatility of your portfolio? I don't think so. I mean, down
at one
60%
time they thought crypto was going to be a hedge against stock volatility, but they found that
I think it's too early to say. Here's the problem I have. I think that blockchain, decentralized finance, smart contracts are potentially wonderfully disruptive financial technology because it reduces financial friction. If I want to send $1,000 to my friend in London, potentially I could use blockchain to do that cheaper than now. Here's the problem that I have. Cryptocurrency, Bitcoin, no real intrinsic value at all. Think about this. It just does nothing. What's it worth? It's only worth whatever anybody will pay for it. So look, I collect rock posters. You see this poster behind me? This is the 1972 Rolling Stones tour. It's a very famous tour that they did, height of their fame. This poster, what's it worth? Well, it's worth whatever anybody will pay for me and I have some vague idea of what it might be worth based on prior sales. I watch the auctions that happen around these things, but it doesn't pay a dividend. It doesn't throw off a future stream of cash flow like a stock would. It doesn't do anything. It just sits there on a wall looking pretty for me. Well, that's worth something. It's a collectible. That's my point. These are sort of collectibles that need to be looked at that way. So I don't have an opinion on Bitcoin. People keep asking me, what do you think of the price of Bitcoin? Is it a buy at 16,000? I have no opinion on it. Just like I don't have a particular opinion about this Rolling Stones poster, though I do own it.
That Rolling Stones poster, I actually know of a guy who paid like $3,000 for a Black Sabbath poster. So, I mean, I'm sure if somebody would have paid $3,000 for a Black Sabbath poster, there's no telling what you got hanging on your wall.
Yeah, well, folks, he's talking about me. Actually, it was $3,500.
Oh, I'm sorry. I went down 500. I apologize.
There's a chapter in the book about behavioral economics and how people do stupid things and how can people do these stupid things. So one day I was watching an auction. There was a Black Sabbath poster, and I don't particularly love Black Sabbath, but this was a very famous one, and it was $500. And I figured, oh, what the heck? It was actually $400, and I'll bid $100 and get it for $500. And all of a sudden, a bid came in right after me, which means somebody's got a series of bids above the actual initial price. And I thought, gee, this is kind of strange. Why would anybody want this poster? And then I hit 600, and then there was 7, then 8, and then there was 9 immediately. And now I'm really annoyed. Like, why is this happening? No, who wants this poster? It's not worth $900. The bottom line, folks, is I ended up buying it for $3,500. I was screaming at at the computer, because you're not supposed to do that. I thought it was worth 500. You be very disciplined in these things. You don't do these kind of amateur things and go over what your mental limit is. But I did, and I actually contacted a behavioral economist about it, wrote a story about it, about why people do stupid things like this, and it's in the book. You can read more about it. But the bottom line was, I called the dealer. I was so furious, and it's not good etiquette to ask the dealer who the other bidder was. You just don't do that. And I said to the look, I said, I know I'm not supposed to do this, but I got to know who's the idiot who thought the Black Sabbath poster was $3,500. I really want to know who this idiot is. And the dealer said, oh, I'll tell you who it is, Bob. It was you. You're the idiot who bought it. And I thought about it. I said, oh, yeah, you're right. Okay.
I hope you come back.
Andre, thank you very much for having me. A pleasure being with you.
Thanks, Bob. Well, if you have a question about finance or a comment about the show, love to hear from you. Make it concise, make it pithy. Write us at andre@wallstreetwrapup.info. Now look ahead for market information for next week. But first, what is the longest-running television show on NBC started on this day in 1952? Well, we'll have the answer in just a moment. Well, what's the longest-running TV show on NBC starting on this day in 1952? The Today Show. Well, Tim Cook, Apple's CEO, is taking a voluntary 40% pay cut after shareholder disapproval of his pay package last year. In 2023, his pay and incentives are going to be dropping from last year's $84 million to just this year at just under $50 million. His 2023 pay package breaks down like this. Tim Cook's base salary is going to be $3 million for the year. He'll get an annual cash incentive to stay at Apple for $6 million, and his equity awarded if Apple hits performance levels are going to be at $40 million. Well, coming up next week, we're going to be talking China and how, through their economic and military might, have now made many U.S. businesses fearful of criticizing their practices. We're going to be talking with columnist, author, and distinguished senior fellow at the Gatestone Institute, Gordon Chang. Gordon's latest book is The Great U.S.-China Tech War, and as in other books by Gordon, he discusses China's rise, their long-term goals of dominance, and the hold they have over many U.S. businesses. Why do companies such as Nike, Apple, or the NBA refuse to criticize China and tolerate their practices? Next week, author Gordon Chang will be here. Well, as a reminder, we repeat the show on Sunday mornings, but the best way, set your DVR so you'll never miss an episode. And that's our show for this Friday, Friday the 13th. I hope you enjoyed it. My thanks to Bob Pisani for joining us this evening. But as always, it is you we appreciate for allowing us into your homes tonight. So remember, follow us on all the social media, Facebook and YouTube, and WYES.org. Have a fun weekend with the ones you love and a productive week as well. The stock market is going to be closed on Monday for the Martin Luther King Day, but I'll see you next Friday. And remember, if it's Friday, it's Wall Street Wrap Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.